Okay, brilliant. Welcome everyone to the Financial Focus Smart Investing. I was really looking forward to this episode today. Zach is here with me, and here we are. Clem is going to join in a second. So, right, how are you, Zach, first of all?
I was waiting for the war yesterday. It was supposed to be Wednesday, the war in Ukraine. Has it happened or not?
I don't know. I read that
I can't believe these things are so unreliable.
Yeah, well, listen, I read there was room for diplomacy. I think that was in the FT. And then the Mirror over the weekend was saying, oh, we are ready 3 a.m. to start shooting people in Ukraine. So I don't know. I think, yeah.
Well, wars are like buses. You don't.
I was going to say, it's like the public transport thing. Yeah, exactly. Yeah, exactly.
No, I don't understand. Why buses?
Oh, it's an old English joke about buses. You're waiting for a bus.
It's not a joke. It's not actually a joke.
Okay. And then the bus never comes. That's why.
Well, it does, but three of them come at once. And there's actually a mathematical reason for that, because they can't get past each other, so they all clump up. But anyway.
so basically, eventually will come. So that we are,
you know, at the end of the day, I mean, I have connections in Ukraine, and they're all going, no, it's not going to happen. No, what a joke. People in Ukraine are saying it's not going to happen. Russians are saying it's not going to happen, and the Americans say it's going to happen, and the UK is all getting all excited. But
and the newspapers told us when it was going to happen.
Ukraine and Britain. There's 4 countries in the way, and there's also a sea. Why do we care?
So I don't understand. So that means that based on what what you have been hearing, is that it's not going to happen.
Well, nobody in the Ukraine thinks it's going to happen.
Yeah, so then it's not going to happen. It's just sensationalism.
But let's just imagine for a minute it was going to happen. Yeah, Russia, Ukraine. There's another 4 countries between Ukraine and the Channel, and then there's Great Britain. It's like us worrying about a war in Burma or something like that.
We did have that in 1939 with Poland. I mean, you could have said the same about Poland, couldn't you?
I don't think the Russians, invaded Germany, and well, they did actually, but but they didn't invade France, did they? And they didn't get through Holland. Yeah. And then they would have had to come over the Channel. But I mean, if you think about it, the Irish got the right idea. They were neutral in both First World War and Second World War.
Well, do we want to talk about Italy? Double faces?
Well, look, at the end of the day, the elites slaughter their children in these wars and normally destroy themselves. Yeah. If you think about the World War I, a load of cousins had a family feud and slaughtered millions of people. Millions of their minions were slaughtered. Why? Because a load of cousins got upset with each other, and in the end killed each other, because they all perished. I mean, the Tsar perished, the Kaiser perished, the Hungarian Austrian Empire fell. Yeah, the only king that kept his head on his shoulders was George V. And what was that all about? What were they trying to achieve there? Please tell me. Were they trying to achieve the slaughter of millions of people? Were they trying to achieve and it destroyed the whole ruling class? All those people war were destroyed by it. And I wish people who are in the elite would think about that, would reflect on the fact that wars destroyed the elite that caused them. So, you know, it's a ridiculous and very, very tragic abomination.
I think that, but the final thing on that is, because we'll go to the markets in a second, but the final thing on that is clearly the First World War was about, the British Empire and Germany feeling like inferior to the British Empire. The Second World War was...
Germany's not a person. Germany's a group of people, most of which go to work and have got much more better things to worry about than getting slaughtered.
Yeah, and the Second World War became about America dismantling the British Empire, which wasn't a win either, really. So that was the worst thing about
it. They were queuing up to dismantle it because it became a liability.
Well, okay, so on the markets have held up then on the basis of no war.
Market, exactly. So today I wanted to throw these things and see your thought. The commodity supercycle.
Well, it's called the inflation supercycle, I think. See, commodities don't go up in value. Money goes down in value. Over the long term, commodities go down because you get bigger and bigger trucks and clever technology and smarter people digging bigger and bigger holes. So overall, commodities go down in value, in real terms of value, because the amount of labor and energy it takes to extract them drops. Yeah, because it all backs out to money, and money backs out to energy. So it's all about how much energy you use to get your stuff. It's all about how much it costs. Yeah, work, labor, standard Marxist theory if you want to be a Marxist about it. So technology drives down the price of commodities, but slowly. But money, when money suddenly devalues, the price of the commodity goes up because the buying power of the money goes down. And that's the super cycle we're in. There's nobody queuing up saying, oh, we need so much more copper there. Oh, yeah, we need so much more of this. Yeah. It's the fact that the value of money is going down because there's too much of it. And people are going, yeah, well, give me some of that commodity because I've got so much of this money, just give me the commodity. That's what causes inflation. More money than supply of goods. And here we are. So it's not a commodity super cycle because nobody's running around going, yeah, we need more commodities. Yeah, we need more commodities. They're running around going, I've got too much money and I don't want this blooming paper.
All right. So my question to you, Clem, is that let's say by the end of the year, we've got, double-digit inflation and it looks like it's really roaring away. If commodities haven't gone up then, or gold is not through $2,000, would there then be a problem?
It's on its way, isn't it, gold? It's on its way now. I mean, it started to be on its way. And I think that the other thing to think about is, and I'm a firm believer in this as an idea, is this inflation accidental? And the answer is no, it's not. Inflation is never accidental. Inflation is always planned. Even Weimar inflation was planned to try to get out of reparations. When you go to Zimbabwe and they've got a $100 trillion note, how long before they printed it do you think they took to actually design it, have a committee meeting to say that they needed it and they wanted it? It's all design. If they're starting to overstamp their banks, even that takes months. Yeah, it's planned. Inflation is planned. This inflation is planned because they need to have inflation because governments have built this huge chunk of debt and they need to devalue that debt. And they need to rebase the economy.
You said that was you said it was planned, but I've never known governments or central banks plan anything. They couldn't arrange a drinks party in a brewery.
Well, just look back at the history of inflation. It always comes after a war. And that's because the countries are all so indebted. They have to have inflation to nuke their debt. They have to have inflation.
Yeah, but the inflation this time, the inflation this time came from supply chain issues because they got everybody working from home or doing nothing at home. They paid them to do nothing at home.
Well, that's their excuse. Their excuse is that it's nothing to do with them. But we all know they printed huge oceans of new cash, and that's what creates inflation. Since the beginning of time, that's what creates inflation, printing new banknotes. And that's what they've been doing. And we've got inflation. If you go to school and do economics as a 14-year-old, they'll teach you that as a 14-year-old. If you print too much money, you'll get inflation. And they print too much money, they got inflation. Are they stupid? No, they're not.
Okay.
They do it on purpose. Yes, they did. Why? Because it's a flat tax and it destroys the value of their debts, which they need to destroy. And it's a way of rebalancing your economy after a disaster. Always has been. It was at the end of the Second World War, when British coins went from half silver to no silver. It was at the end of the First World War, when British coins went from 100% silver to half silver. If you track back the size of copper coins all the way back through history, you'll see that the one large cent in the US after the American Civil War shrunk and shrunk and shrunk and shrunk and shrunk and shrunk. It's what they do when they've got an economic problem. They flush it away with inflation. What's
if this is planned, so first of all, they pump the economy with money and then they have to raise inflation. I'm just trying to understand how they are making money. What's the gain they are getting?
Let me be the central bank for a minute and you be the prime minister. So here you go, Prime Minister. We've had this pandemic, okay? and pretty much everybody's bust. Now, at the end of it, what we can do is we can just let it run. And, you know, the banks will fail, the business will fail, there'll be massive unemployment, there'll be social unrest, there'll be riots in the street. But we won't debase the currency. The currency will be worth, you know, just as what it was before, apart from the whole place will be on fire. Or the other choice is we will print lots and lots of money and we'll hand it out and everybody will be happy. They'll be holding their bills in their hand, they've got free money. And the banks won't go bust, the companies won't go bust, life will go on. However, we're going to get quite a lot of inflation. Now, the good news is all those debts that we built up, paying people to stay at home, that'll all get eroded away. And there won't be anybody collapsing, but things will rebalance and everyone's going to get a haircut. Everybody's going to lose quite a lot of their wealth. But nobody's going to get that as a punch in the face. It's just going to be slice by slice by slice. And we'll boil the frog. And after 5 years, everything will be back in balance because GDP will go up, your tax revenue will go up, they'll go down. Everybody will be looking at a house which is worth 6 million, thinking they're rich, and life will go on. So take your pick. Riots in the street or inflation at 7% for the next 5 years.
So the best thing is to borrow up to the eyeballs, is it?
Absolutely. Isn't it always? Isn't that what the rich people do?
Yeah.
That's exactly what the rich do. And you go to the bank, and I say to my banker, here's my collateral, how much can I have? And they say as much as you like.
Yeah, exactly.
So, 4 times your collateral. So you go out and you buy lots of good collateral and inflation makes your debt go through the floor. And then you end up with mansions and, if you go a bit mad, you end up with racehorses and yachts. And then the market goes against you and you can't pay your yacht and you go bust. But if you buy solid assets, inflation takes care of it, which is why most billionaires get their money from, guess what? Property, which is an inflation hedge. So you've got negative interest rates because inflation's higher than the rate of interest that you've got right now. You just buy an asset. It goes up. Hopefully, it goes up more than the pace of inflation. But let's say it doesn't. Say it just goes flat, right? Well, you're getting a negative 4% carry on as much money as you want. I do that all day. And they do.
Yeah. I'm just thinking,
I think Zach's died. He died in horror and shock.
Well, I'm very much with you. I think it's always a bit counterintuitive, though. With the borrowing and you've got the borrowing to an asset to a hedge against inflation it's a tough thing, I suppose. Just given that
it's a profit.
Yeah,
but you're hedging going on there. You're making 4 or 5% carry. It's like, look, debt is wealth. The only difference is your rate of interest. If it goes over a hump, it kills you. If it's below a certain level, it makes you rich.
No, I think the only problem was in the 90s that you had inflation at like 10% and you had interest rates at 9%, 8%, or plus a bit more, and that was painful if you can't service the debt. I mean, that's the problem.
Exactly.
You can't service the debt. That's the big issue.
Okay,
the other thing is important to know. It's not about the rate of interest. It's about the availability of your borrowings. If you've got a fantastic building that's worth 10 million and you've got 2 million borrowed against it, who cares what the interest rate is? If you can't roll that debt when it comes due, you're in big problems because someone's going to sell that 10 million pound building out from under you at 6. Yeah, even though you've got eight worth of equity. If you've got a short-term mortgage, you've got to roll it for 3 years, and all of a sudden the banks are saying, "Oh no, we don't do mortgages anymore." You've got a big problem. So it's the availability of money that's key, and that's what they're going to do here. Is they're going to keep the availability open, but they're going to raise interest because everyone will go, "Oh, interest rates have gone up." I told you. Oh dear, yes. Now they're doing some stuff to stop inflation. And funnily enough, it won't stop inflation because the availability of money will be there. And they'll still be buying anything that's not there.
So basically, the crucial things is you can borrow as much as you want as long as the interest rate they are not too high. But you need to be able, first of all, to keep rolling your debt and then being able to service the interest rate.
Yeah. So, for example, you've got a fixed rate, fixed term debt, and that rises a long way out. Woe betide you if it's in the short term.
But still, not many places. There are not so many mortgages on loan at the same interest rate all the time. Is triggered to if it goes up or down. I mean,
but you're not super rich, are you?
Exactly.
So
Yeah.
you don't
Okay.
get to
Go
play
on.
this game.
So if you are super rich, you can have a stable debt.
Yeah, you don't get to play this game if you're not high net.
Yeah.
Yeah, it's the same way as the not well-off people haven't been able to sit on equities as they've been going up.
So what is the threshold to the super rich?
Well,
Steffi and upwards.
No, come on, I'm curious.
I mean, you know, you get a large quantity of title inflation as well on these things. I mean, you've got to be looking at more than 100 million. But I mean, I think these sort of things start well. If you, it depends on how liquid you are. If you've got a house that's worth 5 million, you've got tuppence in the bank, that doesn't count. But you know, if you've got a assets of, I think it's probably 20 to 50 million really in reality.
Yeah, which
but I mean, even people that are not that rich can get access to that sort of debt. For example, in equities. Now, if you bang in a million into certain brokers, you'll get 4 million in leverage. And of course, if you then use that to buy things like index funds, which are paying out 3 or 4%, like FTSE, then you've got perhaps 1% or 2% of carry trade, even without it going up. So, you know, the leverage is out there. Leverage is very, very dangerous if you know what you're doing. Yeah. And of course, most people don't know what they're doing, and leverage is what kills them. And it kills lots of rich people too, right? You know, when there's a financial crisis, there's droves of rich people that were billionaires yesterday and are now bankrupt. Yeah. So, you know, it's a very, very dangerous, it's leverage. You have to be very careful. Leverage kills. But nonetheless, if you're going to get high inflation, at the end of Weimar Republic's hyperinflation, they went back to all the people that had borrowed money before it, and they stuck 10%. They said, right, we don't care that your million marks that you borrowed in gold is now worth a postage stamp. You owe the bank 10% of your million marks in old money, in gold, because we're going to reinstate it. We're not going to let you just inflate away your debt, but 10% of what you borrowed in the past is now, we're going to stick that in as new debt to you, because we're not going to let you get away with that. So that shows you, you know, how this thing all goes up in smoke. But even so, if you'd borrowed $10 million in gold before the Weimar Republic had their hyperinflation, at the end of that period, you owed nothing, and they came along and said, actually, you owe us $1 million in gold. Yeah. Because of, I know we cause this inflation. I know you've got away with it, but I'm going to stick it to you anyway.
Clem, now we are seeing lots of rich young people, or maybe they are not young, they have got, for instance, different kind of assets like NFTs. Do you see they become, so do you see like NFT and this kind of digital assets, perhaps crypto, to become an asset class that is going to be considered for leverage position?
Well, you know, it's a classic scam to offer leverage to people. So if people can be scammed out of their NFTs by being offered leverage, they will be offered leverage to be scammed out of their assets. So, you know, it's a classic scam, offering leverage. If you go back to the beginning of time in what might be accounted as non-brokerage trading, i.e. bucket shops in the turn of the 1900s, they would offer you 50 times leverage. Because if you're dealing with 50 times leverage, you will lose all your money. So people will be offered leverage on trading on NFTs or on trading on anything, because that's the way they get scammed out of their money. So yes, it will happen, because lots of financial service providers, the whole business model is scamming you out of your capital.
Yeah. Okay. So I mean, maybe I'm not so. You know, I don't understand very well these things about leverage, a part of the fundamentals.
No, very few people do, which is why they get scammed out of their capital.
Yeah, exactly. So how do they get the money that you are borrowing as leverage? Just to
understand. Very, very simple. I'll be your broker now. Okay, Steffi, I'm going to give you 200 times leverage. Okay. Do you want a spread bet with that? Do you want to stop loss with that?
Okay.
Now, the point is, the volatility is such, you're guaranteed to go through your stop loss, and therefore you lose your asset back.
Okay.
Because I haven't actually dealt you buy I'm going to buy 100 ounces of gold with 500 times leverage. I haven't bought that gold. I just wait your stop loss to get taken out, and then I've made all your money. Every time you pull the lever on the fruit machine, that money goes into my box, and you ain't never getting it back. So the leverage and the stop loss enables a small amount of money to be taken away because the volatility drives you through your stop loss. That's the oldest trick in the book. That's what bootstrap margin used to be in bucket shops. That was their deal. They would say to you, look, all you do is put $2 down at 100. And if it goes below 98, you lose $2. You're going to lose $2. And if it goes to 200, you've made 100 times your money. What could be better? This could be your lucky day. But the point is, the volatility is so high, or high enough, that you're guaranteed to go to 98, 99 times in 100. And you will. So therefore, you're going to lose that $2 every time. It's like if I said to you, look, I will give you a $2 stop on Bitcoin, and I'll give you 500 times leverage. Of course, it's going to go down $2. It goes down $2 every 10 minutes. And the chance of it not going down $2 from where you got in is approximately zero.
It's like crossing a road without looking. I mean,
it's like crossing a motorway, and it's like playing football on the motorway, actually.
Oh, gosh. Okay, that's interesting.
But that's a guaranteed way to lose all your money. That was the business model of bucket shops, and it's still the business model of bucket shops right now. If you get an email from somebody who's regulated in Kathmandu, and they're going to give you 500 times leverage, that's their game. And when you buy Microsoft, they haven't bought Microsoft for you. And, you know, they're just waiting for your stop loss to get fired. And if by some freak of nature, it does just go up, they'll just say, oh, tough luck, mate. Oh, no, KYC, excuses. No, close that position. Bye.
No, say you're an insider trader.
Or whatever excuse they come up with. Or when I once did a political bet and I won heavily on it, they just said, oh, no, it was a mistake. We priced it wrong. Bye.
Okay, here is another thing that I came across in the news, and it was quite interesting. So Warren Buffett, new bank investment. So he invested around, I think it was 1 billion in this digital bank called New Bank, and he offloaded some stock from Visa. And yeah, I think it was Visa and MasterCard, maybe some other investment he did. So I wanted you, Clem, to comment on that. I mean, he's not getting into crypto, but he's buying.
Well, I offered to buy his button off him for $2,000 because he said, "Oh, this crypto, it's like, you know, it's like my button. You know, it's like I can sell. Can I sell it for $2,000?" So I wrote an article for Forbes saying, "I'll buy your button for $2,000, mate. Okay. Come on, sell me your button." Because actually, Warren Buffett's button is worth $2,000. Because of everything that goes around it. It's a kind of a work of art. And, you know, things are worth what people will pay with it. And what people pay for is a semantic web of meaning, which is why money is media. So anyway, he's bought into a fintech. Very good. What I want to know is what he's going to do if Apple has a problem, seeing that 48% of his investments are in Apple. That's a pretty spicy position.
Yeah, but Apple market cap is bigger than all the London stock market together. I still can't get.
I know. What happens if they take a little bit of a sneeze? What happens if they fall out of favor? What happens if their iPhone 47 doesn't sell?
Yeah,
what happens there? So I find that quite interesting that he has basically bound his future to Tim Cook's, which, well, not Tim Cook's really, because he's, you know, but to Apple. If Apple is potentially the ultimate button. I mean, I've never been a fan of Apple. I've never owned Apple. I've always been a bit bearish because I can't understand how a toy company can be worth so much. And but it is, and everybody loves Apple, and they've got magic. But like all stories of magic, the magic has to end. What then? What then for the Nasdaq, for that matter? But what then for Berkshire Hathaway with 48% of their investments in one stock? That's a classic investment error.
Yeah, exactly. Where
he's cornered himself, hasn't he? He's cornered himself. How the hell does he get out of that? Well, maybe he doesn't have to when you're 97 years old, but I mean, you know, that's a pretty interesting.
So talking about Apple, I mean, it's one product company. Okay, they've got different variant of the product, but it's really one product. So what they are doing, what they are into. It's just...
Well, Apple's a very wonderful company with lots of very, very clever stuff, but all of it was invented by a guy that's been dead 10 years. So that's my concern is is that they, all that stuff that they rely upon was designed by Steve Jobs. And you saw what happened to Pixar when Steve Jobs wasn't involved, didn't you? So is that not going to happen to Apple at some point? Is it going to go on forever? Is it going to be like the Catholic Church, going to go on for centuries? Yeah. Anyway, we'll see. We'll see. I just find it more interesting that Buffett has lashed himself to the prow of the good ship Apple. And it better not bump into an iceberg. Otherwise, his legacy is going to go down with it.
Yeah, interesting. Zach, where are you walking?
I still want to buy his butt for $2,000.
Well, he might does it. He might come back to you.
Well, he should do, but he didn't. We rang him up and I made the offer, but
okay.
Obviously his button's worth more than $2,000 to him, which is sobering right there.
I'm curious to see where
Zach is walking through his mansion. How big is your mansion, Zach?
Okay.
It's not my mansion. It's the person who did what Clem said and used leverage and borrowing to inflate away the value of the mortgage.
Oh gosh, how far have you walked?
I've been up and down the stairs. No, my father's 90, so I'm in his palatial mansion, which I'll never be able to do myself, obviously.
Okay. Talking about crypto, let's Clem, what's your weekly comment on what is happening?
Well, I mean, it's all down to Mr. Putin, isn't it? I mean, if he is going to invade, that's going to be pretty spicy for Bitcoin. In fact, you probably can predict whether Bitcoin is going to and whether the Ukraine thing will happen from what Bitcoin does.
Yeah.
If Bitcoin suddenly goes bang, then you've got to go, whoop, I don't want to be in Kiev right now. But if he isn't going to, then I thought that'd be. I mean, I'm quite surprised at just how strong the crypto is at the moment. And I think really you can say that Bitcoin has now got a lot on the flight capital, haven capital thing. And the reason why gold has been so slow is that people, really don't want to have gold if they're going to want to leg it out of the country at the airport. They want Bitcoin. So all that, what would have been an upward pressure, like if you look at gold back in the 80s when Afghanistan kicked off with Russia, bang, it went to 800 because it was the asset for flight capital and for that kind of thing. And I think that is really being undermined now by Bitcoin. However, gold is a fantastic asset for inflation in the same way as Bitcoin isn't.
Yeah.
In fact, if you want to hedge Bitcoin, you want to be in money. It's not the other way around. But anyway, be that as it may, so now gold for inflation, Bitcoin for war, and I think that's a pretty good model. And I think that tension, which clearly seems to be being whipped up by governments being stupid, as they are often. I mean, if you look at the history of war, there's never peasants say, I want to go to war and get slaughtered on the battlefield. It's always the kings, it's always the rulers, the Kaisers and the Führers and the prime ministers and the presidents. They're the ones that sign us up to be slaughtered.
Yeah, where did you get the people from for war these days? I mean, these 100,000 troops. I mean, haven't they read the history books? I mean, are they nuts?
They're young, stupid people. And they probably only got two neurons to rub together, and it's a good income. It's an income, and they've got different standards of living there. It's much harder to get people in Britain, obviously, to sign up to march around a square and wear camouflage. But out in countries where the GDP per head is much lower, it's not so difficult.
Yes.
Yeah.
So I mean, the safe haven at the moment seems to be still the mini mining stocks and the mini oil and gas stocks. Those are the ones that they're not marked down when the FTSE's marked down, and you have that potential upside from commodities from the inflation supercycle.
Yeah. Okay.
Well, trademark plan. But outside of that, I mean, I want to say that the stupid stuff that governments can do, particularly on the war front, is unbounded. So it's hard to say that can't be that stupid. But I want to say it can't be that stupid. You know, they're just trolling each other, and they can't be that stupid. But in reality, history proves they can. But I don't think they will be. But,
no, but I think
I'm quite wrong.
The pandemics proved how gullible we still are. I mean, there's no difference in the gullibility ratio is still as bad as it ever was. I mean, the Scotch. I'm still haunted by the Scotch eggs and you can't get COVID after 10 o'clock, or you can get COVID after 10 o'clock, and all the other conflicting rules. I mean, that is more stupid than sending people to the Battle of the Somme. I mean, that's if you can sucker people on that, you can do anything really.
Well, I mean, Jack, I have a different view on COVID because I nearly died. I was that close.
No, I think no, but the point.
So I do think that
COVID is real, but the rules associated and the whole way it was handled was completely unbelievable.
Well, I think
nobody
I don't know how anybody would have done it.
The cure for COVID was that everybody just stayed at home. That was the cure for COVID, and there would be food delivery, so you didn't have to go out and meet anybody. But you had stay at home, but you can go to the supermarket, get COVID there, come back, and then stay at home again. You had so many rules which were idiotic, and that's the point there.
I think that these responsibilities is never going to be perfect or even brilliant. It's going to be, a set of kludges and mistakes made by fallible people. But outside of having aliens beam down and take over our government, I don't think they could have done it much better with the system that we have.
Or much worse. At the same time.
Or much worse, yeah. I'm Panglossian about it. I think they did the best they possibly could, and that wasn't brilliant, but it was the best they could possibly have done. And I mean, in comparison to like Australia, where everybody was put in prison for 2 years, I think it was, they did a least worst job. And if you look at all the numbers, I think foresight incredibly difficult. Hindsight, obviously, there's so much better that could have been done. With foresight, I mean, I was really, really not in the way of COVID. I don't live in the city. I don't go down the pub. I don't go to football matches. I don't have kids at school. I don't know all that. It still managed to come down my drive and get me and kill my father-in-law. And you couldn't really be more remote than I am most of the time. And in my remoteness, it still came down my drive and really killed me, killed my father-in-law. So, I think that's a very, very, like war, vast mistakes are made. But with foresight, I can't see many people put their hand up and said they would have done it better. So I give all these people that set themselves up above us a pass on that one. Because I did stare at the white light for a few days.
Yeah.
Okay. And I've got a friend right now who's a young guy in his 30s. He's absolutely, he's not fat, he's not unhealthy, and he's absolutely laid flat with it. And it's not even Alpha or Kent. It's the Omicron, and he's going to be sick for 3 months.
He's vaxxed.
Double vaxxed, yeah. So if he wasn't vaxxed, he'd probably be dead.
Gosh.
So how much is this going to be? I mean, so this is never really going to go away now, is it? We've got this for good, haven't we? It's endemic. That's it.
Well, look, when smallpox showed up at the Roman Empire at its peak, it destroyed the Roman Empire. Rome fell, and the whole of France was empty, and all the houses fell into the ground, into dust, and that was smallpox. And it came back twice. It came back, the Antonine Plague came back at the plague of Cyprian. And that, this stuff is real. Everyone wants to a lot of people want to make out plague as a fantasy. It's not the fourth horseman of the apocalypse, not the first horseman of the apocalypse for nothing. It is the first horseman of the apocalypse. It is very real. And thank God, Omicron isn't an extra vicious version. Because I tell you, they would be bringing out your dead like they were in 1666 and 1340.
Yeah, I mean, I would have thought the next one, whenever it is, 5-10 years or whatever it is going to be one of those that you're literally in the plague, 1 in 3, 1 in 4 type stuff.
Well, at least they've got practice of what to do now. At least they've got the plans on how to keep that stuff maybe at bay. I mean, at least they've had a dry run.
Yeah.
And thank goodness. But I mean, 40% of Europe died in the plague in the 1600s. 40%, 4 out of 10, 1 in every 2.5 people. You know, so I mean, it's easy to look back and say, I mean, if you look at the numbers, there's hundreds of thousands of people that didn't die because of it, and you can turn that around and go, well, actually, if they just let it run, it would have taken out 1 year of life expectancy. But actually, in terms of people, that's a lot of people. A lot of people.
Okay, let's talk about something a bit, you know, more bright.
Well, here we are with inflation.
Yeah.
And so that's the outcome. So rather than a collapse of our economy and there being a smoking crater but strong currency, we've got everybody going, oh, blimey, fish and chips have gone up 30%.
Yeah.
Well, you know, I think that's a least worst outcome, and that's why we're getting it, because it's a least worst outcome. But when does it end is the call that people need to make. When does the inflation end? And the inflation ends when our GDP is back under 100% to debt. Maybe somewhere, you know, maybe 90. Somewhere between 90 and 100% debt to GDP is when suddenly they'll pull the handle, and then all of a sudden there'll be
so in the past, when we had, because I was not in the market, or I was not paying attention to that, I was just doing some other things. But when we had interest inflation going up, how long did it take to come down?
Well, I mean, you can bring it down really fast. I mean, normally it's brought down really, really fast, you know, a matter of months, but, you know, it causes a certain large amount of carnage if you do it that way. And these days, the central banks believe they're in a situation too, and probably are, to smooth this stuff. So if you saw in 2008, they would be smoothing the economy and the markets and money supply and inflation for a decade of tweaking, tweak. Yeah. So what they will try to do is what Gordon Brown declared back in the day, that everything was sorted now. It's kind of the end of history of economic boom and bust. Well, that's probably was a little bit brave of him to say that, because we've had a couple of booms and busts since. But they do have, or feel they have, levers to smooth it out. And what they try to do is smooth it. Okay. And of course, you could get in all sorts of problems doing that, and they probably will. But nonetheless, they will attempt to smooth it. So they won't just pull the lever and everyone will go bust. They will grind back to that under 100% GDP to debt. And there's a reason why that number is there. It's because 80% is agreed by economists as being the limit of your debt to GDP, that if you go over it, you kill growth or you hurt growth. And obviously, in terms, government wants growth to be optimal for their taxation and their programs and for their we're a success. So they need to get it down from 110, 120, or wherever it really is, that back down under 100 towards the 90%, so that they can actually have growth, which pays for all their fancy programs.
So it can basically take quite a few years.
3 or 4, easy, yeah. I think 4 or 5, because all you need is another bump. All you need is a Russia invading Ukraine bump, or a Omicron 2 bump, or whatever, yeah. or something, you know, meteorite strikes bump, and then that will get pushed back a year or 2. So 3, at best 3 years, at worst, well, decade. But I think 3 to 5 is probably what you're looking at.
Okay.
Zach, and 7 or 8% inflation to further notice until that point.
Okay, so we need to kind of live with it. Zach, you have your gems, your minor.
Yeah, I mean, I look at the small caps, as you know. At the moment, what's interesting, despite all the uncertainty with Ukraine and everything else, you're getting small mining companies and small oil and gas companies, you know, the sub 50 million pounds area is starting to move very well, and I think that might be, and that still is the sweet spot of the market, even if there is the worst thing that happens. But it's obviously that is favoured by inflation, so they're favoured by inflation, and I think if you get the right company, you're geared up very well to that. So I mean, the small gold companies, mining companies. There's the ones I know well are Extract Resources, which is copper gold, Wishbone Gold in Australia. I think they're nice because they're sort of Australia focused. But just anything small in the mining space, with more than just a bit of blue sky, but a bit more than that is, I think, something to look at. So that's good. But I think the good thing about the small cap area is that you know, the FTSE's down 200 points, but it doesn't affect that. It doesn't affect much, you know, whereas if you've got BP or Shell, you know, they just mark it down because it's part of the index. So, which is very irritating. So just those small caps in the mining area, and maybe oil and gas too, I think. And it's quite a big remit, so you can enjoy yourself, but it's as opposed to other stuff, which I think is tougher to call.
Okay.
I think Zach is spot on with small caps, particularly if you play small, because you can get in and out. The trouble is, if you play large, you can't get in and out of these blooming stocks, and you know you can't do 100 grand. And you get a stupid price going in, you get a stupid price going out again. Yeah. So that means you have to move upstream.
That's
it's not like 10 grand of like 3 miners and 2 oil and gas or each, you know. So if you put in 50 in total, but you know it's 10, 10, 10, etc. So it's something like that is more of a, you know, in this sort of market is more doable. And who knows, one of them might be a 5-bagger.
I think that's right, and I think that reflects something that people who are watching this need to consider is the quality of your platform. Yeah, if you're on a platform that just says, "Oh no, we won't quote you," "Oh no, we don't want any of that now," you really do need to get off that and get onto a platform where they give you a price, or where you could go directly into the order, because you know there's nothing worse than wanting to buy a stock. It says can't sell you any. And I know a lot of people have got brokers that won't. You know, in America, this would be hilarious. Americans will go, "What is that? Are you kidding me? I can't sell 5 grand. They won't. I've got a stock that I can't sell 5 grand off."
Yeah.
Or when I go to sell 5 grand of it, they'll offer me 7% less than the price. I mean, what is that? But you know, that is a reality on certain platforms in the UK. And people who want to play to win do need to look to their platform to give them execution so that they can move in and out of 10 grand on these things, rather than get told that they can't even sell £500.
But I think you know, 10 grand is like the perfect amount for the small cap space. And even if you're rich, I think it's just a perfect amount, because it's, you've got to run it, because if you are rich and you want a big profit, you've got to run it. But if you lose it, it's not going to kill you. And I think that's the, I mean, you know, you're not going to be happy, but it's I think that's the sweet spot at the moment in this in terms of liquidity and just, you know, the position size, etc.
I take it from a game theory point of view, and that is positive sum game, negative sum game, zero sum game. And if I've got a stock and they want a 5% spread, I'm probably not going to play, because you know a stock on average is a 7% upside a year, and I'm not giving them 5% to play that game. I'll just find something else. So for me, the spread is all important, and I won't play in stocks of any size, even medium-sized stocks. Sometimes will have a 2% spread. I won't play. I'm not playing that game. There's 2,000 stocks out there. So people need to look at their platform. They need to look at the spread, and they need to look at their ability to get in and out of these plays. And yeah, small, medium-sized, not micro, but you know, small companies, 10 grand is kind of like when it starts to get a bit sweaty. Then I mean, I must say, I don't like to sell and then come back tomorrow and sell. I want to be able to get out like that.
Exactly. And also, if you want to go, you know, if you are looking for high return, then it's just better that you go in crypto, because you can make more than 5x. I mean, you can make.
No, I think that's wrong. I think you need to know what you're doing.
Yeah, well, definitely.
And if you don't know what you're doing, you shouldn't be doing it. And if you don't know which direction it's going, what the hell are you doing with it? So you need to know if it's going up or down, and you need to know what you're doing, and you need to do it with good tools, and then you need to make it.
But I'm saying if you kind of want to get into spicy stock opportunity, whatever they are stock or whatever they are crypto, I would rather tend to crypto rather than go to stocks.
Well, I would say if that was your phraseology, you should go home and forget the whole idea. Getting into spicy stocks, that's like saying, I want to go to the casino to gamble. Well, if you gamble, you're going to lose.
Maybe I said wrong, spicy stock. I said
you didn't, because that's what a lot of people are thinking.
Exactly. Yeah, more kind of like gem, more stock they are beginning, or no stock, companies or
if you're beginning, you should buy the lowest possible risk stuff. You should be buying the FTSE tracker, and you should be buying the blue chips, and you should be following it. You should be learning the game.
Yeah, definitely.
Yeah? If you're going to play the game down in the small caps, you better be an expert like that.
Yeah, no, exactly. Yeah, but I didn't mean to be
30 years.
I meant if you want to build your portfolio with some higher return project. Okay, so you want to look at smaller.
No, you're doing it again. There's no such thing as a higher return project.
Well,
you don't know whether it's going to be a higher return. You know it's going to be a higher risk.
Yeah, exactly.
And that maybe lead to a higher return.
Yeah.
But you need to get it the right way round.
Yeah.
You want to go, that's a high return. No, it's not.
No, you should exactly high risk.
You don't know it's a high risk, but you've trained yourself up to have more skills than average, and therefore you can take on more risk. And you have the system and the portfolio and all the things that go along doing it, and the platform and the tools to be able to take on that higher risk. Yeah. You know, if you go hunting wild boar, you wear a bright orange shirt so no one else shoots you.
Yeah, no,
right? You take on the tools to take on a higher risk, and then you don't get shot. Maybe you still get shot, but you know it's lowering your risk as low as possible by using skill and technique.
Yeah,
that other people would be taking on a higher risk in the same trade. But because you protect yourself, you're going to win more often than they are on average, and therefore make more money.
Okay, but if you want to take high risk opportunity and you are aware of what you are taking, I will tend more towards crypto than towards stocks.
Yeah, but if you don't know about it's like Zach, he don't know nothing about crypto.
Yeah, then you go.
It'd be wrong for him because it's like a chess grandmaster playing tennis.
Yeah.
I mean, you're in the wrong game.
Yeah, Umbria, what's that?
Oh, Umbria is heading to $8.
I thought it was a province in Italy.
No, he's heading to $8.
It's got a bridge called Narni, which bridges stuff across. And it's called Narni for that reason, because it's a bridge in Umbria.
Ah, see, I'm an expert now.
Oh, listen, last time we talked, it was $2, or maybe the time before that. So I think, he's on a nice path.
Well, my view on crypto is this. What does it do? This sort of thing. Does it do something? Can I use it? Does it exist? Is it a great product? Well, rather than talk about the fact that Umbria has gone up 700% in the last 3 months, I would prefer to say that it's got a great product for bridging tokens from Ethereum to Matic. And it's a great ability for people to stake those tokens and make a good return with fees from people who want to do that. And you know, I'm all over providing liquidity to that bridging because the fees are great, and that's what drives the whole thing. The price of Umbria is just a reflection of its product. It's fantastic. Yeah, it's a fantastic product. I use it every blooming day. I use it because if I'm doing anything on Matic, I'm doing anything on Ethereum, or I'm doing anything on Binance or Avalanche, I can move my Ethereum around between those different networks and chains, and I don't mind paying a 0.3 or 0.5% to move it, because if I use someone else's bridge, it's costing me 5 times as much, it takes 3 times as long. And the technology in Umbria is that much faster and cheaper and more reliable, and gives me more feedback as a user when I'm going, oh, I've just sent $5,000 over to Binance, where is it? Oh! And boom, 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 much nicer than the alternatives. But that business model is what drives everything. So I don't really mind. I don't really look at the Umbria price. It's gone from 50 cents to $7.80 in the last year. That's secondary to the fact it's got a fab product that I need to use. I'm a user one of this blooming thing. And that is what drives all crypto. Forget Umbria for a minute. It's what drives all crypto. And if you haven't got a use case, you haven't got a business model, then, you know, that's a problem for me. That's my model in crypto. But boy, don't get involved in crypto unless you skill up on it and you're comfortable with it, because otherwise you're gambling. And gambling, gamblers lose. There's 2 sorts of gamblers. The house, they don't gamble, they stake. And there's the gamblers who bet, right? Staking and betting, 2 things. People who bet lose, people who stake win. And you know, that is the name of all these games. Are you the house, or are you the gambler? If you're the gambler, you're going to lose. If you're the house, you're going to win.
On that bright note,
love the jumper, by the way.
All right, Zach, are you okay?
Not really, no. No, I'm fine actually. No, I'm just. It's been an hour nearly, so I have to head off and do what I try to do every day. And it's been great and everything. But yeah, no, I'm just, nothing to worry about, just a bit of war and
well, we'll see next week what is going
Well,
to
before you go, let me just say one thing. Rothschild once said, and it's always been true so far that I've seen, buy to the sound of gunfire.
Sorry, buy to the
sound of gunfire. So if war does break out, you probably want to go long.
Okay, that's
unintuitive, but Rothschild did say that. And if you backtest that idea, generally speaking,
yeah, no, and it does actually make sense as well. It's one of the best sayings in the stock market. So, thank you, Mr. Rothschild.
Okay, on this note, Clem, thank you so much, and Zach as well. I will see you next week. Thank you, everybody.